So hello, welcome back to a new video here on the Tradeciety YouTube channel, and today I thought I'd make another video about the stochastic indicator and how to use it, and especially how to not use it, because I get often emails, well, very often emails about people who say that they are using the stochastic indicator and then it's giving them wrong signals, but then when I ask them about their trading screenshots, then they use it in a very wrong way. And it mainly relates to the use of overbought and oversold. And I think I've never seen any other topic in trading that is as misunderstood as overbought and oversold. So let's take a look, for example, at a few scenarios. Here we have a very long period of an overbought, oversold market, and really, you need to stop using those terms. They're really bad. Oversold does not mean at all that the market is ready to reverse. And if you are one of those traders who starts trading against the stochastic, if you see oversold, then you are going long, then you will, I promise you that, lose all your money, because oversold, if anything, does not mean that the market is oversold and that the market is ready to reverse. If anything, oversold means that the market is in a very weak state and it's likely to continue its downtrend. So what is the stochastic doing? So let's start here. We have a 26 period stochastic. So the stochastic indicator looks basically at the past 26 candles. So let's take a look at, for example, here, and then we use this tool. You can see 26 bars is here. So in this period, the stochastic, what it does, so this stochastic value here, I will mark it for you. This stochastic value here, which is very oversold, you can probably see it. Let me move it so that the buttons in TradingView are not in the way. So let me do that again for you. 26 periods with the measurement tool. 26, yeah. So the stochastic looks at the range of those 26 candles, and it looks at the high and it looks at the low. The low in this case should have been here actually. Because the stochastic looks at the absolute low, which means that it uses the candlestick wicks. So here is the low, here is the high. I will just mark that, the period, and then I can draw it for you more easily what the indicator does. So this is the period that the RSI, the stochastic is looking at. We have the high, we have the low, and we have the range of 26 candles, okay? So far so good. So why is the indicator in this case oversold? It is oversold because the indicator looks at how close to the low has the price closed. So you can see the price has closed quite low to the absolute low point, which is the wick of this range. And you can see it is quite a big range here, or quite a big drop from this period to this point. The price has moved a significant way. And at the same time, the price is still closing very close to the absolute low, which means that the market is pushing down very strongly. And the indicator here is, in this case, 12.6, which means that 12.6, it means that the market is only 12.6% away from its absolute low in this whole period. So you can see how or what the indicator is actually doing. It is not showing you that the market is ready to reverse, or it's not looking for any signs of weakness in the market. It is showing how strong the market is pushing into a direction. So the next candle here actually, when we look at this area, 26 should be then here just one candle from here to here. This should be 26 periods. And you can see how close the market is to its absolute low. This is even lower. You can see the market has closed here. The absolute low is here. So it's very close to the absolute low. And in this case, again, it is 11.8. So we are very close. It would be 0 if the market is closing at the absolute low, at the absolute candle low over the past 26 bar range. So you can see how the market is showing you the values of an oversold market. And in that context, you will see that when the market is, or when the stochastic is oversold, it means that the market has traveled quite a significant way, if you use it in a trending market, of course. and that the market is very, very close to pushing further into the direction of the trend. So in this case, the market is and was pushing down. And if you start trying to go long when the market is entering oversold, which has been here, so here it entered oversold, because you can see the market was already here trading lower from this point, then you will run into deep, deep troubles, because look at what happens here. You are going to short, you are going to long, and you're going to buy in this very, very strong downtrend, which is obviously not going to work out in your favor. And this is something that you can often see. And if anything, then you should start using overbought and oversold as a trend following indicator. Of course, there are other things that you need to understand and use. Stochastics in general is not, and just like any other indicator, is not going to be a standalone trading strategy, so you can build confluence factors around that as well. But I just want to warn you, here was a recent example as well, when the market was staying in overbought, in this case, for quite some time. You can see from this point, we entered overbought and we traveled all the way up until here. So you can see overbought, and if you are in a trending market, then it is more of a trend following signal and not a trend reversal signal. It is very, very important to notice distinctions. Here as well, recently we were looking at this market with our pro members because it was in a very interesting trending phase. We then had the breakout, which led to a move higher here out of this range. And then here we had a short period of an overbought market. Many traders, they were already looking for short positions here during this phase, because, well, one of the reasoning of many retail traders is often that the market has been going on for so long, at one point it must reverse, and how does the saying go? What goes up must come down. Not true. Well, with some caveat, it is true, but the time horizon, the market can keep going for much longer than what you can handle with your account balance and with your emotions. And yeah, I just recently took the short here with a very interesting signal. You can see I'm just mapping out my trade. This is a pattern breakout trade after the market has completed its final move. You can see we entered overbought here at this point. So around this candle, we entered overbought. You can see we exited overbought at this point here. And then with some other confluence factors from my trading strategy, it signaled a short trade. So again, you don't go against the stochastic indicator, then you would have lost a lot of money if you try to short in this uptrend. But look for signals that the market is really losing its momentum. And this will happen based on momentum analysis. I have made a few videos around momentum analysis as well. And then you can get into the safe zone where you are not trying to short in an uptrend, you're not trying to short a complete market top, but you are taking the safe spaces in between, not the highs, not the lows, but you take the safe meat in the middle, and that's then where your trading will see a better results, hopefully. And yeah, if anything you take away from this video, don't use the stochastic as a trend reversal indicator. Use it, if anything, if you're in a trend, as a trend following indicator, and you will already make much better decisions. And of course, I always recommend that you really understand the indicators that you're using. Don't just slap an indicator on your chart and then look for random crossovers or look for signals that somebody has told you will work. Most of the cases, the people have never looked at really what the indicator is doing, how is it calculating its values, and what is actually doing. So start thinking for yourself, start experimenting, learn the tools that you use, and then you will see a big improvement in your trading. Bye bye, and see you in the next video.